financial position, we talk about money, markets, politics, and markets have gotten silly and insane. And I want to revisit what we talked about last week when we opened the program, and that's the insanity over this GameStop stock. And just to review with you, it's a short squeeze. It was a short squeeze. People on an internet forum with 2 million followers on that forum researched that GameStop had 140% short interest in the stock, meaning that not only was all the outstanding shares sold short, but 40% more. Now, I can explain how that can happen, but it's too lengthy and it's too in the weeds. I don't want to go there. But basically 140%. So what does that mean? It means that if anything good comes out or if the stock starts to go up, these people have to buy the stock back and return it to wherever they borrowed it from. And anybody who wants to borrow stock and sell short can do it. I mean, these big clearing firms take it from one account that somebody has and gives it to you and you sell it. Now, they don't see the difference because they still see the stock in their account. But it's basically owed them. So if you think a stock's going to go down, say it's $10 now, and you think it's either going to go to $0 or $5, you'll borrow the stock, sell it at $10. You'll get $10 in your account, and you have to return the stock sometime in the future. And the longer you wait, the more it's going to cost you to borrow that stock. So what you want to have happen is you want that stock to drop in value so you can buy it back cheaper than you sold it for. And again, a lot of people have problems understanding this. And it's not that complicated. You sell first and you buy back later. It's that simple. And the whole idea here is the opposite of buying low and selling high. It's selling high and buying low. So you borrow the stock from the brokerage firm, you sell it with the hope that it goes down, and you can replace it for less money than you sold it for. So if it drops to $5, I could buy it at $5, get back the stock, and I keep $5 profit. Now, big firms like hedge funds, they do this in hundreds of thousands of shares, millions of shares in some case. So a lot of these big hedge funds are like sharks in the water. They feel that GameStop was going to go bankrupt, and it probably will, because they have these strip mall stores that sell video games. But just like Blockbuster went under, once you were able to stream live on TV or download, you didn't need CDs anymore, they went bankrupt. So these hedge funds look at a way of making money by selling it short at 15, 14, 13, whatever, and they'll wait till it goes bankrupt and buy it back for $1 and make a huge profit. Now that's fine if the stock doesn't start going up. And what happened was all these 2 million people on the Reddit forum said, look at this big short interest here. If we start pumping this stock up, these hedge funds are going to start losing money, and then they're going to have to buy back the stock they borrowed, and that's going to push the stock up even further higher. And boy, were they right. They were right. A stock that was 17 in early January rapidly ran up by mid-January, late January, the 28th, to $513. Now, this is a religious experience for the short position. Because think about it. If you buy a stock at $10, the most you could lose is the $10, your investment. So if you bought 1,000 shares at $10, it costs you $10,000. That's your investment. If it goes to zero, what's it worth? Zero. You lost $10,000. But if you're short a stock, there is no limits to your losses. Unlimited losses, infinity losses, until you buy and cover the short. That's called covering your short. So say you shorted at $10 and now it's $30. You're down $20,000. You only got a $10,000 credit when you sold it. And now it'll cost you $30,000 to buy it back, if you buy it back at this time, and you'll lose 20 grand. What happens when it goes to 50? What happens when it goes to 100? Think about the potential losses here. And we're not talking people with 100 shares. We're talking financial institutions, hedge funds, with millions of shares short. Remember, 140% of the entire outstanding shares was sold short. So every one of those people started to panic when it started to go up. And billions of dollars were lost by these big Wall Street firms. One, Melvin Capital, which is a hedge fund, lost $3 billion, roughly half their assets on this short squeeze. Now, there's another reason why these Reddit people on the chat rooms went after it. And these are mainly small investors, but there's 2 million of them. It's because they wanted to put it to the man. They say that, and rightfully so, that in many cases anyway, not all the time, that short sellers are predators. That they smell blood in the water, and then they hasten the demise of the company by pressuring their stock through massive short selling. What makes it difficult for the company to raise capital because the shares are too low, and a lot of things go on with that. Totally legal. But the short sellers, especially the hedge fund short sellers, are used to winning. And many times they collude amongst themselves. You'll have 3 or 4 hedge funds, 5 hedge funds. It's a very tight community, all going after the same stock. So it's a self-fulfilling prophecy. If they're all selling it and selling it short, it's going to keep pushing it down. But then the Reddit army came in and started pushing the price up. And that's when the religious experience happened for these hedge funds. And they had to buy. They couldn't take the risk that this is going to keep going up. They already had lost billions of dollars. But did they leave it open and lose billions more? No, and their clearing firms are telling them to put up more collateral or more capital. Because now the brokerage firm's in trouble if they get so broke that they can't pay back the money. So they were forcing them to go and cover the short and take the loss or put up more money. So it was a pretty amazing thing. It happened in a number of stocks. The most notable one was GameStop because it went from 17 to 500. I mean, briefly. But this week, the empire struck back, as I knew it would. Well, it started the week before. I mean, that's when brokerage firms started preventing their traders from buying GameStop stock. So basically, Robinhood, which is the main platform for the small investor, they charge no commissions, told all their clients basically, you can't buy GameStop and other stocks that are heavily shorted. Basically rigging the market for the short position. Because if the only thing you can do is sell, and there's no buyers. By the way, institutions were allowed to buy, but just the everyday person wasn't. They were allowed to buy to cover their shorts. So anyway, the stocks come all the way back. It closed Friday at 64. I mean, after being in the hundreds. For days, actually. Actually, 64 is the lowest it's been in 2 weeks. Now, was the damage done to the hedge fund community? Yes, because a lot of them were forced to take losses. They couldn't ride it out. Unless they shorted up at $300, $400, $500 and now made back all the money they lost on the previous short, which they probably did, with the knowledge that Wall Street and the brokerage would do what it took to bring reality back into that stock and basically rig the market for the shorts. Now, the absurdity of this is if you go to the Reddit forum, WallStreetBets, that's the subreddit. Okay, Reddit's a big community, and they have all different what are called subreddits for every subject you could think of. And WallStreetBets is a subreddit for investing. But if you go on and you read about it, many of these people didn't sell a share on the way up. Many of them became multimillionaires on paper, but never sold. That's absurd. That's irresponsible. That's like a children playing with matches. What are you doing? And the reason being, many of them said, was because if we don't sell, the stock will keep going higher because the shorts will have to keep covering it. It'll go to 1,000. You want to talk about greed? Now it was some kind of social justice cause or something to take out the man on Wall Street that they stopped thinking about profits One guy, a young guy, built the account up to something like $25 million. And he gave back $16-17 million last week. And he still hasn't sold, from what I know. What's wrong with you? When you invest money, you never make money until you sell. Paper profits, nice to look at. They don't pay the bills. And I've seen a lot of greed on Wall Street over the years. And I've had a touch of it myself in certain trades and whatnot. We're all guilty of it as investors. But I've never seen anything like I saw in the last couple of weeks. There's people on the forum who are suicidal. We're going to have many mental health issues because of this, because a lot of people came in and started buying at 100, 150. Many of these small investors took their life savings and put it in this. Buying a almost bankrupt company because they thought that it was going to go to the moon. And it did go to the moon. How could you not sell at $400? How could you not sell at $300? Stock that you may have bought at 15 or 20. Or even 50. At least sell enough to take your investment out. This is trading discipline. And I've been a trader. I'm a day trader. I don't know if day trading is the right word, but I make trades every day in my trading account, my personal account. And I try to use certain disciplines when I trade. When you make the money, you take the money. That's how you make money in investing, is you take profits. Sometimes they're small profits, sometimes they're huge profits. Or at least protect yourself. How do you protect yourself? Well, you could put a stop loss order in. What's a stop loss order? It means, say a stock's trading at 100, but you don't want to sell it for any less than 90. You want to keep riding it if it continues to go up. But if it goes down to 90, you want to be out. That's it. That's as much of the profit you want to get back or the most loss you want to take from your original investment. And what will happen is if the stock trades down to that number, whatever that number is you pick, it will automatically be sold. Even if you're not around, it automatically happens. And that's a good thing because you've put some discipline in. I'm willing to give back 10%, and that's the most, and I'm going to take my profit. But many of these traders, if you want to call them that, they're kids, many of them, didn't do anything like that. And they just watched it go down and down and down and down and down. And then they followed everybody on the forum and says, no, don't worry, don't sell, it's going to go up again. So now they're feeling a sense of community. And people have to understand, there's no community in investing. It's one for themselves, each man for themselves. And I watched it with just astonishment that so many people didn't sell any. Can you imagine a $50,000 account go to $3 million? Would you sell some? And I'll tell you one thing, I would have sold. And I would have sold all of it on the way up. Maybe at different prices, maybe not at the ultimate high price. But I don't play in that, in those stocks. I'm not, those are gambling. I'm not buying a bankrupt stock at $50 a share just because I think it may go to 100. It's just not the way I've learned how to invest. And again, when you see what goes against you, you're in big trouble. So now the question is, GameStop is worth 5 or less, probably going to 0. You think they'll sell at 64? No. They'll ride it all the way down to 0. Because why would I sell it at 64 when I saw it at 300, 400, even 500? When it goes back there, this time I'm smart enough to sell. But many times it never gets back there. And I don't think the stock will ever get back into the multi-$100 range again. The shorts have covered. The longs, the speculators who all came in, they all own their stock already. Where's the buying pressure going to come from? That doesn't mean it can't go up $30 tomorrow. I mean, it may. But I'm saying is that these people learned a very, very, very important lesson about investing, which is when to sell. And that's the most important decision an investor has. Now, buying's important too. You got to buy at the right price, but selling is where profits and losses are made and realized. Everything else is fantasy until you execute the transaction to sell. All your paper profits could burn away in a bad market in just a couple of days. People experienced that early last year. And you have to be disciplined in your selling. If you're going to be a trader, a relative short-term trader, or even a long-term trader, you have to, when you buy it, have a strategy of how you're going to get out and what you're expecting the investment to do. And many people learned a hard lesson. And again, many people now, they were also giddy and gleeful. Look what we've done. We've stolen. They didn't say stolen, but we've transferred billions of dollars from those evil Wall Street hedge funds to our pocket. Well, it wasn't in your pocket till you sell it. And many of them gave it right back to Wall Street. Now, the next thing they decided to do, to go after the Reddit people, was silver. Now, silver is a little different than GameStop. And silver has a commodities exchange, a futures exchange where it trades. And these exchanges are run by the biggest banks virtually in the world. These are not hedge funds that don't have unlimited resources. And the problem is, in a futures contract, there is unlimited supply. So it's not like, the thing will keep going up and up and up. There's no silver that changes hands. It's just physical contracts. It's just paper contracts. So what happened on Monday morning, silver started to go up on Friday. On Monday morning, silver went up $3 early in the day. And it was up to $30 an ounce. Now, just realize, not long ago, silver was $20 an ounce. And last March, it was $14 an ounce. So it spiked up $3. And all of a sudden, it started to ease off. Closed up, almost $2. But the next day, silver was bombed. And this happens all the time. If they ever paid attention to that market, they would have known that's not a neighborhood you want to go into. It's been manipulated for years. It's the big boys. It's not the hedge funds. It's the big banks on Wall Street who have this huge short position. And we're not about to get GameStop. And because they have such big pockets, basically unlimited pockets, because they have the Federal Reserve. And another thing, too, is the central bank doesn't want to see gold and silver running away. Because that'll show inflation. That'll show that they're debasing the currency. And they don't want that to be, being talked about on financial news. And there's no way that these big firms were going to lose on their short positions. They never, ever do. So they picked on the wrong people. And on Tuesday, silver was down over $2, and it continued down pretty much the rest of the week until Friday. Went as low as, I think, 24, 25. So any of those Reddit forum people who thought they could take on the silver market, they learned a big lesson and lost a ton of money doing so. And I knew that. I knew it. I knew that. I know this market. I watch it trade. Out of nowhere, sometimes you'll see a whole year worth of mine production sold in 10 minutes because it's not real. Futures contracts are paper. There's really no. You take a gold contract. It's for 100 ounces. Rarely does somebody come in and say, give me the 100 ounces. No, they just trade it by paper. If I got a profit, I sell it for a profit. If I have a loss, I sell it for a loss. But what we're seeing now is we're seeing investors going into the futures market and saying, I want the 100 ounces of gold. I want the 5,000 ounces of silver. That's a silver contract. Because there's such physical shortages all around the world. And that's an interesting thing. The premium, if you can get a silver eagle 1 ounce coin, they're out of stock almost everywhere. But if you can get them, it costs you $40 for an ounce of silver that's trading at 26 on the COMEX. Think about that premium. That's a $14 premium on a $26 contract. So you're talking about a 50% premium. I've never seen it that high because it's never been that high. And it's only in the silver and gold market where you have no supply, the mint has run out totally, people are calling up coin dealers like crazy, and the price of silver goes down and gold goes down. It's the only market. They should be skyrocketing. You know, you learn markets, economics 101. Supply and demand. If there's more demand than supply, the price goes up. Not in the COMEX market, it doesn't. Because it's so highly manipulated. And these big firms have been fined repeatedly for rigging markets. One firm got almost $1 billion fine for rigging the metals market. I think the bank starts with a J. So that's one market that's incredibly manipulated, and you don't. And I watched 25 years. I've watched the manipulation and raping of the speculators on the silver market and the gold market, for that matter. And it goes on every day. And they like it very much. They make billions of dollars doing it over the years, and it's been like a cash machine for Wall Street. And I knew they were shorting the hell out of it at 30. I know the big boys are out there because it hit 30 and it just wouldn't move any further. And they were just shorting it and shorting it and shorting it and shorting it and shorting it. And then they bomb it the next day. They cover the short. They make a ton of money and the speculators lose. So I like to think that this whole Robinhood, Reddit absurdity is kind of dying down now. There's going to be more and more restrictions on that ability to do that. I don't know what you can do. I don't see why you can't have a forum where people talk about a stock and all decide to buy it at the same time. That's not illegal. But now you have Wall Street, these brokerage firms just changing the rules. Oh, by the way, with silver too, this is another thing that they do. Tuesday morning, the day after silver started taking off, the COMEX raised margin requirements. What does that mean? When you buy a futures contract, you don't pay 100% for it. In the case of silver, it was something like 16%. So if you're going to buy $100,000 worth of silver on the futures contract, you would have to put up $16,000. Well, they upped that to over 18. And this is what they always do. They always up the margin requirement when they want a commodity to go down. Because number one, it costs more for anybody to speculate in it. They have to come up with more money. But also existing contracts that are already out there, thousands and thousands, hundreds of thousands of them, all now have to come up with more money. Or they have to sell the contract. And many of them opt to sell the contract, pushing the price down. So that's one way to manipulate the market. Now, who controls the futures exchange for metals? The same banks that are short the metals. They run the exchange. They make the rules. So do you see how it's a rigged game? Think about it. They make the rules and can manipulate a market by just upping the margin requirement. And they always do it when the metals are moving up and people are making money. and then they short it like crazy and everything else. So I knew that these people were making a big mistake taking on the big boys on Wall Street. The hedge funds are one thing; they have limited amounts of money. There was limited amount of stock available on on GameStop. But when it comes to the silver and gold market, unlimited deep pockets and unlimited paper contracts. All right, let's take a break. 732-505-1160 is the call number. My name is Lou Scatigna. Don't go away.